Yeah, December was a pretty volatile month actually. We did see that Australian shares and bonds finished a little bit higher, but overseas we saw global equities and global bonds finish a bit lower. It was interesting, through 2015, we did see pretty disappointing results actually. Returns across most asset classes were below average. So Australian shares returned about 2.5% for December. They were one of the stronger returning markets. Again, over the year there's a little bit more muted, so we saw around 2.5% return again for the year. But most of that came from dividends, where the strong dividend yield for Australian shares really returned or generated most of the returns. For the first time since 2006, we saw the US Federal Reserve increase interest rates. They've moved effectively from 0 to 0.25%. We're expecting to see another interest rate increase in March, and most economists expect the increases to be pretty gradual through 2016, maybe moving to a point where they get to about 1% by the end of the year. China's economic growth remains a really important point for global investors. What we saw in 2015 is a continuation of the transition from manufacturing to services focused for their economy, and that certainly saw lower commodity demand for Australian commodities such as iron ore and oil through 2015, and we'd expect that to continue in 2016. So 2016 started out as quite a volatile year in investment markets. We continue to view that the best way to deal with volatility is to make sure we're well diversified in how we invest, and also suggest that clients, if they have questions around their investment strategy, should contact their financial planner.